Okay, chapter 14, puts and options calls. So in chapter 14, we're going to talk about the basic nature of options in general, puts and calls, what they are, understanding how these investment vehicles will work and how they can make you money. Describe the options market, the key option provisions, including strike prices, expiration dates. Explain the puts and calls, how they're valued, the driving forces in the market that change their value. Describe the profit potential for investing in puts and calls and different put and call strategies. Potential for your loss and the exposure that you can get. Different option positions have different loss consequences. We could talk briefly about market index options and leaps, foreign currencies. So an option can really be placed on any type of asset. It doesn't have to be limited to stocks. So a financial asset is exactly what it seems like. Some sort of asset that represents a financial claim on an issuing organization. So like stock would be, it's the financial asset that represents the ownership of the company. Gold itself would be a financial asset that represents the value of the gold. You have an ounce of gold. So a financial asset is just a financial claim, either by owning the asset outright physically or having a representation of the asset like a stock certificate. Now an option is a contract that's derived from the asset. That's why options fall into the category of derivatives. So derivative just means this particular investment vehicle derives its value from another underlying asset. So that's why options can be applied to anything. They can be applied to chairs, tables, textbooks, currencies, stocks, bonds, indexes, trash cans, anything. You can put an option on anything. So I could give you an option, say, I'll give you the option to buy the Xbox One for $500 from me up until December 31st. So for that option, you'll pay me $10. So the $10 is what you pay me to get that option, which is a contract between you and me saying, I'll sell you the Xbox One for $500. You just want to guarantee that you'll be able to buy an Xbox One in case when you go down to actually buy it, because they're $349 now. So you go and buy it, but what happens? It's sold out. So more people purchase these than they made them. So now you go everywhere, you can't buy your Xbox One, and you desperately need one. You promise it to give it to a gift to maybe a brother or sister or a disadvantaged child or something like that, and you'll feel really bad if you can't deliver it because you made this promise. So you go to eBay to buy your Xbox One, and now they're trading at $800 a console. So now that option comes in handy because you can come to me and say, okay, I'm going to pay you the $500, and then I'll give you the Xbox. Because I already purchased it for $350 a few weeks ago, and I've just been holding them. But even if I didn't purchase it, I still would have to give it to you. So I have to go and buy it for $800 on eBay and give it to you for $500. So I'd lose on that deal. So if I was smart, maybe I figured that this would happen, and I bought a bunch of them at a cheap price. And now when people are coming and the contracts are valuable, they're buying from me for $500. And then you can turn around and say, well, I'm not going to give it to my brother anymore. I'm going to actually sell on eBay for $800. And there's nothing I say about it. Because it's like basically a promise to sell something to you at a specific price. What if oil companies do this all the time for home heating? You can make a contract with them and say, lock in a certain price of oil, home heating oil, for the next year. So if oil prices go up, you don't pay the higher price. But if oil prices go down, you still have to pay the higher price. But that's a contract. The option contracts are different than that, but same sort of concept. You go into a contract with somebody, and for a specific period of time, you agree on a price to buy or sell an asset. And then you're going to pay them a premium or to get that contract from them. You don't get it for free. So they're selling it to you. All right, so there are different types of options. We have puts and calls. Put options are sort of like a short sell. You're buying the right to sell an asset at a certain price. A call contract is like a long position. You're buying the right to purchase something. And there's also rights and warrants, which are other types of options. Warrants are usually written for bonds and rights for stocks. But they're the less common options. The more common, the 99% of the option market is puts and calls. And they come into a derivative class of investments, along with futures, forwards, and swap contracts. Okay. So like I said, you could trade these options on stocks, on indexes, on exchange-traded funds, on foreign currencies, debt instruments like bonds, commodities, and financial futures. So there could be options on commodities as well. So if you buy an option, a call option, you have just that contract. You don't actually own the stock. So you have no voting rights, you receive no dividends, you have no interest. If it was on a bond, you have no privileges. Because you don't really own anything, you just have a contract. Okay. Now, what's great about options is it gives you leverage. So you can buy, if you bought 1,000 shares of Google or Apple or Chipotle Mexican Grill, stocks that are between $500 and $1,000. You're say it's a $600 stock. That's $600,000 that you have to invest to buy 1,000 shares of one of these stocks. However, you can use an option contract to create a leverage position, meaning that typically you may only have to pay $40 or $50 a share to lock in the option contract. So you don't have to pay $600 a share. You can pay a lot less. It may even be $20 a share as a premium to lock in that right to buy that stock at a certain price. So that creates leverage. So instead of investing $600,000, you may only have to invest $40,000 to have an asset which is really the value of 1,000 shares of one of these stocks. So you don't have to have a lot of capital to create these large positions in stock. And as the share price changes, the premium will change for the option contract depending on how valuable it becomes or how less valuable it becomes. So it's sort of pegged to the value of it. Now, puts and calls are created by individual investors, not companies or organizations. Two investors basically get together and say, I want to buy a call contract, you want to sell a call contract, and the exchange will create it for us. But the companies themselves get no benefit from this. They receive no income, no benefits, no fees. The exchanges and the brokerages get commission for setting these contracts up and facilitating a market for us to trade them in. Okay, so say you're an option buyer and you have the right to buy. You basically have the right to buy. In this case, I'm going to consider all options to be stock options for the purposes of this class. So you have the right to buy or sell a stock, if it's a put option, at a particular price. And we're going to call that the exercise or strike price. So that is the price I'm locking in, like that $500 price in the Xbox One. And it's only good for a given period of time. It's not good forever. So it might be 2 weeks, 2 months, 3 months, 6 months. And the longer it's good for, the bigger the premium charge is going to be. So if you're going to acquire this right, if you're going to buy an option contract, whether you're buying a call or buying a put contract, you're going to pay a premium to the person who's the seller of the contract. Or sometimes we refer to that as the maker, because when you say seller, it gets students confused. They think selling stock. No, you're not. So I'm going to call we can call the person who buys the contract actually the person who buys the contract. But the person who actually is selling the contract, we usually use terms like the contract writer or the contract maker. So not to confuse you with buying and selling. So I'll use one of those two terms, either the writer or the maker of the contract. But you're going to pay them a fee for being the one to initiate and make the contract that they're going to sell to you. And you'll pay them a fee for this. So as a buyer, you don't have to exercise the contract. So if that Xbox One stays $349 for the next 2 weeks, then you don't have to exercise the contract. You just lose the $10 you paid me to lock in the $500 price. Yes?
This is a pretty specific question, but is there a way to lock in like the low gas prices now via options?
Yes. But it's really a transfer. You could buy probably an ETF that's based on oil or gas prices. And then if you would probably want to sell it, no, you could buy it. So if gas prices went up, the profits you made on that option contract could subsidize the extra money you paid for the gasoline. So you would have to really, you have the real world of buying and selling gasoline at the pump. That's going to be whatever it is. But you can make a counter investment so that way if you're afraid of gasoline prices going up, you invest in gasoline, a gasoline-related ETF. So if prices do go up on gasoline, now you made profit from this investment, and that's going to hopefully, that will offset the losses of the additional money you pay at the pump. And companies do something like that all the time, but usually with foreign currencies. If you're McDonald's and you're going to bring in a lot of money from foreign currencies, and you're afraid of those currencies weakening, you can buy these, they can do options, but they're more likely going to do future contracts to lock in a price they're comfortable with, so if the price falls, they're still going to get what they expect. But they're going to pay a premium for that. Although a gas station, if they wanted to be a little bit more inventive, they could probably write a contract for, like the oil companies do, the home heating oil companies, and they could say, yeah, we'll lock in at $3.15 a gallon. We'll lock in, your next 1,000 gallons of gas. And, it's currently at $3.05 or so, the gasoline, but it could be $4 again. So maybe maybe your business delivering pizza, you use a lot of gas, you want to definitely know what your gas expenses are going to be for the year, gasoline, so maybe you buy that contract. Now what the gas station is going to do, they're going to turn around and take all this money that you paid for the right of these contracts, and then they're going to lock in the gas prices by buying or selling futures contracts to get a lock in a certain price. So they're basically making sure that they don't get affected if prices go up or down. They won't take a hit because they're locking in a certain price, and then they're promising that to you. And they may not charge you anything. They may be able to lock in a price of $3 a gallon, and then they've contracted to sell it to you for $3.15. So the premium on setting up that contract is going to be part of the profits from the $3 to the $3.15. But gas stations don't do that. Home heating oil companies will do that. That's how they're able to lock in a home heating oil price, is because they will use these types of contracts to lock in a price for themselves and then sell it to you and lock in the price for you. And a lot of people don't like the fluctuations of gas or home heating oil, so they like the comfort of knowing this is the rate I'm going to be paying. And it's the same thing for businesses that do that they could do that with energy or currencies or interest rates. But as individuals, you could also use options as insurance on your stock. So say you own 1,000 shares of Apple, you don't want to sell it, but you're worried that a correction in the market may take $100 off the share price of Apple. You can buy put contracts that simulate short sell. So you can buy put contracts equal to the amount of shares you have. And if the stock price goes down, you'll lose $100 per share in your real stock account, but you'll be making probably a very similar amount on your option contract. Now the option contract is not that expensive to purchase, so if the stock price goes up, you'll lose that money you used to set up the option contract, but it's going to be less than 10% of your position in stock, or 10% of the money you would have lost if you didn't guarantee it. These are confusing concepts, so if your head is spinning now, you're just not kind of sure what I'm talking about, this is where reading the chapter before next class will really help to get you caught up to so when I go into the calculations, you'll be a little bit more stable, solid at what I'm talking about. So basically, when you buy this contract, you're just acquiring the right, but not the obligation to buy or sell. So once you have an option contract, you could just let it could be like buying a gallon of milk. And you have the option to use that gallon of milk or let it expire. So it's the same thing with this contract. You could either use it if you see that it's valuable to use, or we'll get that later. I don't know where it went. Or just let it expire. Now the seller, which I like to call the writer, this person actually, they're the person who actually is kind of creating the contract that they're going to sell to you. So the writer, they receive a premium. So think about this. Think you have 10 stocks in your portfolio, and you're going to write contracts on all those stocks. People are going to pay you a premium of anywhere from, it could be 25 cents to $50 a share, depending on a number of factors we're going to go over later, that you earn for writing these contracts. So it's a way of generating some income. Now, if the stock prices stay in your favor, you get to keep the premium and you don't have to sell the stock to them. But if I have the obligation to sell to you, so say we go into a contract and you're going to buy one option contract that represents each option contract always represent 100 shares of stock. So you buy one option contract with a $10, let's say a $1 premium. So that means you're going to pay me $100, $1 for every share of the contract. Now, let's say the stock price is at $20, and that's the strike price. We set the strike price at $20. If that stock goes down to 15, you're not going to want to cash in that contract, because that would mean that you would have to pay me $20 a share to get 100 shares of stock, and you can go buy it in the market for 15. So why would you use the contract? But let's say, for example, I promised to sell you 100 shares at $20, and now the stock goes up to $40 per share. Now you'll definitely want to exercise the contract, pay me $20 a share, I'll give you the 100 shares, and you can go and sell it for $40 a share in the marketplace. So you don't make $20 a share because you already paid me $1 premium, so you're only going to make a $19 per share profit. But you're fine with that. I lose out because I'm not going to be able to get, I have to sell it to you for 20, so I'm not going to be able to sell it at 40. Now hopefully I already own it. If I didn't own it, it would be called a naked call, and I have to go buy it for $40 a share to sell it to you at $20 a share. So my loss would be $19 a share because I got a $1 premium from you. Yes?
So I'm going to guess that this is heavily regulated or something, because if you make promises that you can't...
Oh yeah, you can't get out of these promises because they're connected to your brokerage account and the exchange. So even though it's really a contract between two people, you don't know who the other person is, and the brokerage and the clearinghouse guarantee execution. So if you have the type of option contract where you have unlimited loss, the broker will shut it down before you run out of money and trade it off to somebody else. So these contracts always execute. They're always, they've never defaulted because you're out of control of it. You don't have the control of it. So it's not like, the exchange, there's option exchanges involved and brokerages. So once you make the obligation, sort of like a margin in your stock account, they'll make sure that you never get to a point where you can't pay up. And if that means closing your positions at a loss on your side, as long as you have the cash to cover it, they'll do that before they're at any risk of losing money, because they will always honor the contract. But that's a good question. So the puts and calls, they trade in the open market just like stocks, but they have their own exchanges. The CBOT, Chicago Board of Options Exchange, is one of them. The value of these calls and put contracts are going to change as the value of the stock changes, because they're tied to the value of the stock. So if on a call contract, the stock price goes up, the contract becomes more valuable and the premiums go up. And there are other factors that are going to influence the option prices. One of the big ones is time. So if you have an option contract that's good for 5 years, that's more valuable than an option contract that's good for 5 days. Because you have think of it like if you had one lottery ticket, would your chances be better if you had 100 lottery tickets versus one lottery ticket? Chances will be better if you had 100 lottery tickets. And that's sort of like if you had 1 day on the market with your contract or 100 days on the market with your contract. Your chances are better the more days you have that you can get a more profitable position on the stock price. Right. So leverage is a key part of this because you only have to put a small percentage down to make a lot of money. Maybe as little, if the futures contract would be as little as 2%, but options contract might be more closer to 5 to 10%. So if you have a $600,000 position, you may only have to put $30,000 down to control a $600,000 asset. And if the asset goes up 10%, you've just made 100%. So the asset is $600,000, goes up to $660,000, a 10% increase. You paid $30,000, and now you're gonna receive $60,000. That's a 100% increase on your initial investment. So leverage magnifies your returns on smaller increases in the stock. So a 10% increase in the stock could be a 100% return to you because of the leverage. Now, option buyers' potential loss is only limited to your premium. So if you're buying contracts, whether they're puts or calls, your only loss that you can't avoid is the premium. Just like when you buy a gallon of milk, the only money you're going to lose is the price of that gallon of milk. If it spoils, expires, you lost that money, but you're not going to lose anything more than that. So whatever you pay for the option contract, even though a $30,000 set of option contracts is worth $600,000, you only could lose that $30,000 for the premium. And investors can make money when the value of the assets go up or down. So the put contracts is basically short selling. So if you think the stock price is going to go down, you buy a put contract, and if the stock price does go down, that becomes more valuable because the puts are basically short selling and the calls are long positions. So the disadvantage if you buy these puts or calls is that you don't get any dividends or interest. Because you really don't own anything except this contract. So you have no ownership. You can't vote on any stock because you don't have any voter rights either because you don't own any stock. You just have an option contract on the stock. And the options expire, so they're not good forever. So you have a time horizon where you have to use it. If you don't use it, it expires and you lose your premium. And options are typically riskier than stocks because it's sort of like options are. If you ever play a slot machine, maybe not at a casino, maybe at online, just for fun, and you know that the odds are in the favor of the person who is running the slot machine. So if you're playing slots on Facebook, and generally you play long enough, you lose all your money. There might be points where you're up some, but the odds are in the house's favor. With the option contracts, the odds are in the writer's favor, so they are riskier than stocks. And if you're the seller of the contract, your risk may be unlimited. So if I sell you the right to buy a stock at $100, and that stock finds the formula from converting seawater into gasoline, suddenly the stock's worth $5 million a share, and I promise to sell it to you for $100 a share. I got to go now buy it for $1 million or however much I said it was and sell it. So I could have unlimited losses if I write what would be a naked short position or put contract. All right. Okay, so we'll stop here. Next lecture we'll start on how the call contract works, and we'll go through the mechanics and the calculations. So please read the chapter if you can so we can go through this a little faster, and I'll see you next class.